Hey everyone, we get this question a lot, so I thought I would answer it in a video format so that you can pause, rewind, rewatch as needed. The answer, unsurprisingly, is it depends. So, what are your choices? You can keep it simple, be a sole proprietor, with or without a name and/or partners. Or you can create something outside of yourself by incorporating a separate legal entity with a number or a name and shareholders instead of partners. Next question, when do you pull the trigger? Sometimes it's not up to you. If the only way to get the work, and therefore the money, is to incorporate, then that's what you do. Depending on your industry, you might have government or insurance rules that make it mandatory. Other than that, there are two major reasons: liability and tax. Of course, the hot button one is tax. Over 10 years into this, you get to hear every myth. The reality is that the write-offs are the same. You can be just as shady with a sole proprietorship as you are with a corporation. Don't be shady. The idea that corporations have secret expenses that make shareholders rich are just not true. The tax story has a couple of twists. The idea of lower taxes seems obvious if you only look at part of the picture. Hopefully this diagram will help. If money goes into a corp, it pays low tax, as long as it stays in the corp. If it goes in and comes out to you personally, the corporation didn't act as a shelter. So, if your reason for incorporating is tax, ask yourself if it's going to do what you hope. Technically, this is the end of our answer, but everybody's favorite follow-up question is, now despite this being the best presentation you've ever seen, your cousin's wife's brother-in-law told you that even if you don't keep the cash in the corporation, you can pay dividends. That gets taxed less. The government already thought of this, and it's called integration. Integration basically says that no matter how the money gets from the customer to your personal pocket, the tax is roughly the same. I use the analogy of a pair of pants with two pockets, corporate and personal. Here's how it flows through. Salary is a business expense that lowers profit and lowers corporate tax. Dividends are not an expense, but a distribution after corporate tax. So if you were looking at the personal tax, dividends look better. You'd be foolish not to incorporate and pay dividends, right? How about now? The main difference is how much came from which pocket. In the case of salary, they got you at the personal tax level. With dividends, they got you at the corporate. Overall, same. There are some nuances at different income levels, and there is a whole discussion about pre-tax and post-tax dollars that we won't get into here. Our opinion, don't let the tax tail wag the business dog. Get that money first, because tax is mostly a concern for those with profit. All that being said, incorporating is not super expensive, and it's not hard to close if necessary. Whichever way you decide to go, we can help you with the name, registration, bookkeeping, and taxes. Thanks for making it to the end, and let us know how we can be better.